A very good evening, ladies and gentlemen. The Internal Audit Standard Board and Management Accounting is back, yet with another exciting program on frauds and internal audits. All of you very well know that fraud is a very, very fatal thing which not only hurts the corporates but the nation at large. We have a very experienced speaker, Madam Archana Moge, who leads the internal audit function at NIIF Infrastructure Finance Limited. Archana is an internal audit, fraud prevention, and investigation professional with an experience of over 22 years. She has worked with leading banks and financial institutions, including HDFC Bank, Axis Bank, NPCI, and Bombay Stock Exchange. Archana is qualified as a chartered accountant, CFE, and DIP IFRS from ACCA UK. Archana is also an active speaker at various seminars, conclaves, roundtables organized by ICA and WRC. She is also a frequent speaker at our Forum of Internal Audit Standard Board. Ladies and gentlemen, I would like to put across a very important thing. If you want to grow in life, either in service or in practice, you need to always be in search of larger and very important areas of expertise. Fraud in itself, fraud and forensics. In fact, I'm the vice chairman of Internal Audit Standard Board and I'm chairing the Digital Accounting and Assurance Board, which takes care of forensic, which takes care of information system audit. And I'm also the chairman of 7 countries IT committee, SAFA, chairman of IT committee. So largely, I understand one thing with my experience of over 30 years, that if you want to grow into a greener pasture, you should find out areas where you can contribute and you have an expertise. As an internal audit, we understood that where the control environment gets weakening, the weakening of control environments provides a breeding ground for frauds. Over the years, the international markets in India have been devastated largely by frauds which have happened at various stances at various stages. Very importantly, you have to understand that when you remain glued to the earth with the best practices, you always score higher into the sky. I'm reminded of a couplet which says, "Aasmaan pe kisi ke ठिकाने नहीं होते, आसमां पे किसी के ठिकाने नहीं होते, जो जमीन के नहीं होते वो कहीं के नहीं होते." The English version is that no one has his place in the skies. A man who is not of the earth is of nowhere. And it is a factual thing. As a professional, we should understand internal audit to its basics, the standards on internal audit, and then we have to venture into fraud and forensics. Like to give some updates on forensics. Your institute, the Institute of Chartered Accountants of India, under the aegis of Digital Accounting and Assurance Board, has promulgated 23 forensic standards which have been made compulsory from 1st July 2023, meaning thereby that any chartered accountant who indulges or undertakes any assignment of forensic nature, it has to be in conformity with the forensic standards as promulgated by ICA. We had 23 forensic standards. And when we made it compulsory, we were very keen to ensure that general membership has guidance on each and every standard. For that, we did so many programs. But apart from that, we had a battery of 150 chartered accountants who took one standard that was divided 20 standards because 3 of them did not need any guidance. They were definitions or overarching documents. But the 20 standards were divided into 150 chartered accountants. They created groups, brought out with guidance to the screening committee. The screening committee looked at the entire thing, again sent them back for corrections or improvements, if any. Then when the final draft came, it was submitted before the expert committee. When the expert committee gave its consent, it was sent for public exposure. And simultaneously, 3 legal reviews were done. And then the document, implementation guide on forensic standards, is before. It is before all of us. It is there at the website. You can always go and download the forensic standards and the implementation guide. And at the same time, I want to put across that if you want to become truly an internal audit professional, fraud and forensic is an area where you get a lot of impetus. I would like to very candidly put across that as a professional, the learning which you get by going into fields which are not traveled much are the best. There's a saying which says, difficult roads lead to beautiful destinations. So when you understand frauds, you understand investigations, you understand how to use forensic for unearthing certain frauds that may not be evident, you ultimately graduate as a professional par excellence. I will not speak much because we have Madam Archana Moge. I have known her over the years and I've always respected her technical skills. She understands internal audit and, more importantly, frauds and how to combat them. And her discussion would ultimately put all the participants at a parlous where they go home more enlightening, putting at rest all the doubts that may have crept over the years. So not standing between Madam Archana Moge and the entire crowd, I would like to withdraw. And at the same time, I would take this opportunity to wish this webinar a great success. I have with me Mr. Mr. Arun Agarwal from the board who takes care of the programs of all the courses. I'm thankful to Ayaz from the technical team and all participants who have gathered in large numbers to go home more enlightened. I can only assure you that whenever you find any topic where you want our indulgence, feel free to give a call to me. I'm always available. You can take my number from ICI.org. You can write to me, you can mail to me, you can speak to me, you can WhatsApp to me. Any mode of communication, we would be keen to ensure that we have best of the topics for your kind consideration. So thank you, ladies and gentlemen. I withdraw. Let us now listen to the golden words of Madam Archana Moge. Madam, the dice is all yours now. Thank you.
Thank you. Thank you, sir. Thank you. Yeah. Is my screen visible?
Not yet, madam. You have to put it on.
Okay. Yeah. Is it visible now?
You will have to share it, madam.
Sorry. Yeah, I guess it should be visible by now.
Right. Yes,
okay.
Ma'am.
Okay, thank you so much.
Yes, madam, it is visible. Please go ahead.
Yeah. So, good evening, everyone, and thank you, Nandaji, for your always so inspiring shairi, and taking a cue from that, like what Mr. Nandaji said, just summarizing the English meaning of it, that yes, we can always reach the skies, but our feet should be firmly on the ground, on the basics. And once you master the basics, the greater destinations and the greater expertise can always be gained by continuous learning and striving for a continuous learning environment. So taking a cue from that, I start with my short explanation into the details of the internal audit and fraud detection and global trends in that. But before I start, thank you, Nandaji, for this opportunity to speak on one of my favorite topics. Thank you for this. I'm sure it will be a very interesting session because what I have tried is I have tried to take case studies rather than getting into theoretical part of it. So I'm sure everyone will enjoy this session.
Yes, madam. Please go ahead. Please go ahead. Best wishes.
Yeah. So, yeah. Yeah. So just a disclaimer that presentation is only for informational purposes, and the views expressed here are my personal views and do not represent the views of my employer or any other authority. So the agenda set over here is back to the basics. What are the basics of fraud? Why fraud happens? What is the motive of fraud? Then we move on to 3 case studies. The way these case studies work is the latest crypto verdict, which has come on 2nd of November. I have done a study of that verdict and what actually happened and how it could have been prevented using internal audit as a tool, using internal controls, what could have been done in a better manner to avoid such kind of a situation. The second case study is more about sales misconduct based on the OCC verdict, which came last year. Okay. And still it is hanging on because there are many cases in India also wherein we have seen such misconducts happening and such gaps being there in terms of banking and other areas. So the idea of this seminar or session going back is the global trends. So the question is why global trends are important. So global trends are important in terms of learning from them and then implementing the best practices, learning from others' mistakes. There is no better thing than learning from others' mistakes and learning from the global fraud areas. So let me start with my case study 1. Before that, I'll just go through the basics very quickly. So now, what constitutes a fraud? Now, as per section 447 of the Companies Act, fraud in relation to the affairs of a company or a body corporate includes any act or omission at the same time. So doing something or not doing something, concealment of any fact or abuse of position committed by any person or any other person with connivance. So there has to be a connivance in any manner with the intent to deceive or to give undue advantage, to gain undue advantage. So there are 3 elements coming here. One is the act or omission. Second is there should be an intention to deceive. And third is damage or detriment. So there should be a damage or detriment of the other. So why fraud happens? So there are 3 basic corners because of which fraud happens. First is there is an opportunity. So basically there is a knowledge and ability to carry out the fraud and internal control weaknesses there. This mainly refers to maybe customers or employees who sees the opportunity, who sight the opportunity and try to use it to their benefit. Second is the pressure or the incentive. So when I say incentive, it means a luxurious lifestyle or motivation or incentive to commit fraud. And second is the pressure. So pressure in turn means that there is a need, a desire, or there is a pressing need because of which the fraud is committed. Okay. Third aspect is the rationalization or justification. So the third aspect is rationalization of those pressure and opportunity. Okay, so let us go ahead. So major categories of fraud. So the major categories of fraud are accounting manipulations, corrupt practices, cash embezzlements, fraud in computerized environment, financial leakages, and financial crimes. So if you see, most of these areas are very common. They are either related to accounting, one, or they are related to a computerized environment. And ultimately, it's the financial crime, which may be something related to investments or investments related to third parties or multi-country kind of frauds. So yes, so what does it take to be a good fraud investigator? A good fraud investigator is one who can think like a fraudster. So when can you think like a fraudster? When you know like what should be the controls, then you would know that what are the controls which are not there. Once you know the controls which are not there, it will be easy for you to identify those areas and kind of visualize as to what bad could have happened, or who could have used the system, who could have harnessed that opportunity and used it and rationalized it and done the fraud. So a fraud investigator should also think like a fraudster, because that will help him get and nail the culprit. Yeah. So coming back to my first case study, the first case study is about the verdict which has come out on 2nd of November by Sam Bankman-Fried, who was found guilty on all 7 counts. Okay. Now, what was he found guilty of? He faces a maximum sentence of 115 years in prison. But what was he guilty of? What is this all about? Okay. This is the biggest crypto fallout. Okay. So, founder and CEO of bankrupt crypto exchange FTX. So, who is this Sam Bankman-Fried? He is the one who graduated from MIT. His parents, both of the parents are professors in Stanford. Okay. A major liquidity crisis led to bankruptcy last November, November 2022. And this year, the verdict has come against him, as he pleaded as not guilty on all the federal charges in Jan 23. There were other of his helpers, or all the people or employees. There were 2-3 employees who were also found guilty in this. They had pleaded as guilty in February 2023, that is beginning of the year. And now in November, we have this verdict. So he was convicted of a fraud for stealing $10 billion from customers and investors. So let us try and understand as to what happened over here. Why did it collapse? Was there any oversight over here? Like, who was the governing body? Who were the board of directors? Why did they not find out before? Was this a big deal in crypto, really? This wasn't so much into crypto, but it was more of governance, absence of governance, absence of risk management, absence of accounting and auditing and internal controls. Now, why do we need to learn about crypto? We don't invest in crypto. So why do we need to learn? But we need to learn about it because lots of investments have gone into it. Okay. This is actually pertaining to the hype that crypto used for alluring these investments, and then the money was siphoned out into other avenues. And the last is, what do we learn and how audit could have helped here? Yeah. So let us try and understand what this complaint is about. Okay. So SEC filed a complaint. Now, what is this complaint? It pertains to representations made by Sam Bankman-Fried, that FTX is a safe, responsible crypto asset trading platform, touting FTX sophisticated risk measures. So it claimed that we have automatic risk mitigation measures, automatic risk management. Okay. So we have a software code which takes care of the risk management with respect to the crypto to protect customer assets. Okay. So basically, once a customer invests in those crypto bitcoins, there is no risk, because it is system driven. That is what it claimed. So the complaint alleges that in reality, it was a fraud. There was hardly any risk management. Money was lent to the sister concern Alameda. Easily, it was an extended line of credit. Whatever went into, the FTX, it went into Alameda. And Alameda in turn invested in those crypto coins. Now, the undisclosed version undisclosed diversion of FTX customers' funds to Alameda, his privately held crypto hedge fund. So the funds were diverted over to Alameda Research. And who was there in Alameda? Yes, there was a CEO who were his friends, but the controlling authority again was Sam Bankman-Fried. The undisclosed special treatment afforded to Alameda on the FTX platform, including providing Alameda with unlimited line of credit. So basically, it could just draw on the line of credit at any point of time. Funded by the customers' platforms, funded by the customers, and exempting Alameda from key risk mitigation measures. So undisclosed risks stemming from FTX exposure to Alameda's significant holdings of overvalued illiquid assets. So Alameda in turn held in illiquid assets such as the FTX tokens themselves. Okay, and then the complaint alleges that Bankman used FTX customers' funds. So basically, customers' funds were diverted to Alameda to make investments. Investments were like real estate purchases, political donations. So everywhere the money has flown. The SEC complaint was also against one Mr. Nishad Singh. So the charges are that Singh also helped in this fraud. Okay. Now, what is Singh done? Singh has created a software code. Now, all these people are, hardly 30, 31. So why have they committed the fraud is by absence of any oversight. Okay. Singh created the software code, allowed FTX customer funds to be diverted to Alameda. So Singh was the software guy who created the code. Okay. Now it is important that whatever code you are creating, it has the relevant risk mitigation measures. It has the controls in place. Now this code helped divert the funds from the customers to Alameda. Okay. So the risk mitigation was absolutely absent. Okay. And it claimed that Alameda is just like another customer. However, Alameda had an extended line of credit, as we saw in the previous slide. Yeah. The complaint alleges that Singh knew or should have known that such statements were false and misleading. So the claim that Alameda was just like any other customer is totally false. Again, the second allegation was that he was an active participant in the scheme to deceive FTX investors. It alleges that even when he knew that FTX was diverting funds, he has not taken any measures and he silently allowed that diversion. Okay. He directed hundreds of millions of dollars of FTX customers' fund, which were used for the additional venture. Okay. Now, moreover, after he came to know about the collapse, he withdrew $6 million from FTX for personal use and expenditures, okay, including his house and donations to charitable causes. Now, that is using the customers' funds for own benefits. Was there any oversight? Well, there was no oversight. There was no board. There was no person who reported to the board or brought out the early warning signals as such. There was nothing of that sort. Okay. Was this a big deal in crypto? It was a big deal because there is a lot of hype in crypto as such. However, if you see the nitty-gritties all boil down to governance, management, and integrity. Okay. Now, why should it be important for us? Why do we care? Well, why it is important for us is because the hard-earned money of pensioners, sometimes these are the avenues which people invest. Okay. Now, in this case, the Ontario Teachers Pension Plan, it had invested $95 million to the troubled cryptocurrency exchange. So, a lot of hard-earned money has gone into it. Now, OTPP, Ontario Teachers Pension Plan, is the third pension fund in Canada. And it made investments in FTX International and FTX US Exchange through the Teachers Venture Group. Now, they said that, yes, it is representing only 0.05%. However, it is a hard-earned money which people depend on. at the end of their retirement. They're expecting money out of it, and boom, it has gone into crypto. Yep. So what went wrong? What were the red flags? Were there any red flags? If there were, then why they were not taken care of? So crypto as such is a very new and a hyped product. Okay. So it is very less regulated, in the sense the regulations are still evolving. Okay. So considering that the regulations are evolving, there was not much of regulatory oversight. Hence, there was not much of compliance. However, a company, no matter what regulations are or what regulations are not, the oversight, it is very important that the company should have the oversight and a board who oversees and questions the management. So FTX, going back to 2019 and 2020, FTX wanted to be listed on NASDAQ. What did they do? The company understood that it has to have policies and procedures audited. So senior management just scrambled to pick up a few things here and there, made up policies, showed it to the auditors in 24 hours. Yes, we have these policies with us. Majority of FTX accounting was conducted by a small external firm. And Mr. Ray, who was later on appointed as the CEO, he himself says that they had no specialized knowledge relating to cryptocurrencies or international financial markets. So the takeaway from this is it's important to hire accountants, auditors, finance, risk professionals, because they form the core system which can help identify those red flags and early warning signals. They will help to identify where the assets are. Lack of accounting controls. Key documents, including cash flows, statements of equity, intercompany transactions, related party transactions, did not exist or they weren't prepared. So basically, these basic things are not there. Okay. There was no such thing as intercompany transactions or related party transactions, although there were such transactions. Expenses and invoices for FTX were submitted on an online chat platform, and supervisors approved it via personal emojis. Can you imagine? Personal emojis were used. Personal emojis were used for approval. So someone has an invoice, he just sent someone on Snapchat or some other chat mechanism, and with an emoji of a thumbs up, it was approved. Okay. Now, messages sent on chat platform and secure messaging apps were used to process approval for transfer of tens of millions of dollars. So when Ray, who was the next CEO who came post the collapse, when he went and checked, like, how do I see where the funds have flown? Let me see what approvals are there. So there was nothing. Everything was on chat. So FTX had difficulty understanding even its own positions. Like in June 2022, portfolio summary claiming to model cryptocurrency positions held by Sam Bankman, Alameda Hedge Fund stated, with respect to valuation inputs, that personnel should come up with some numbers, IDK. So meaning they themselves, IDK is what? I don't know. Okay. They themselves don't know what its positions are. Okay. And they just want someone to come up with some numbers for giving it to the markets. Bankman acknowledged the situation at FTX, writing in one of the internal communications that, hilariously beyond any threshold being able to get partially, we sometimes find 50 million of assets lying here and there. If we had lost track, we find it again. So basically, there is no record. Okay, such is life. I mean, this is the most striking and I would say surprising way of writing that, we lost track of it. Such is life. But the fact is, such is not life. Okay. If you are managing assets of people for $10 billion, you cannot say, okay, we found it over here and we found it over there. It happens. No, it does not happen. There were around 130 entities. A web was created by uh, the old CEO, Mr. Sam Bankman, and he found that 56 entities within FTX did not produce financial statements of any kind. When 35 entities used some small software like QuickBooks, which was used for small and medium-sized enterprises, and was not a full-fledged ERP. Well, the learnings over here is companies with operations as big as $10 billion, they have to use advanced ERP systems, own proprietary system. It has to be customized to their needs. Now, John Ray took over the crypto exchange company after it filed for bankruptcy. John Ray was also involved in the restructuring post the Enron crisis. So he was an experienced hand. Bankman took multiple personal loans from his trading firm Alameda. Bankman told regulators he reinvested the money back into the exchange. But Ray said there's no documentation of what the loans were, how they were used, where the money has gone. And at least in one case, Bankman Fried signed the loan both as the issuer and the recipient. So he signed it as the issuer from FTX as well as the recipient from Alameda. Okay. So this is clearly interconnectedness related party, and there were no action was taken. It was not reported anywhere. So virtually no distinction in the leadership between FTX, its US arm, and the trading firm. And basically, it was nothing. It was something like the owners could just run free all among themselves. I mean, the only red flag over here, I would say, for investors is to run where there is no oversight, where there is no board. Run from such companies. Don't ever invest. So, how could IA have helped? Now, IA or internal audit, how could internal audit have helped? Coming back to the basics, plans, controls, procedures, risk management and methods, processes, SOPs, everything which is good was not there over here. FTX lacked management oversight and governance. There was no independent board to serve as a watchdog. There were no accounting and financial controls. Personnel for financial reporting, risk management, auditing, and accounting were not there. The policies were generic. The policies, as you saw in the earlier slide, they wanted to list on NASDAQ. They had to scramble and get the policies audited, and they got something and got it audited within a period of like 24 hours. Intercompany transactions that were there, but there was no reporting. There was no formalities, no arm's length, nothing. There was a free flow of money between Alameda and FTX. There was no documentation on where the money has gone, what is the reason, nothing. So, what exactly has happened is this is nothing but a house of cards. And it has collapsed. Once even one card out of it is taken off, the entire thing collapses. So, at the epitome of it is the governance and risk management practices which should have been in place, irrespective of size, irrespective of whether there is a regulatory authority or not. It seems simple, but such practices have to grow as the organization grows large. Further, lack of regulation is not an excuse for lack of governance. Even if there is no regulation, governance is something which you need to have. It is not for governing authorities like SEC, SEBI, RBI to come and tell you that was this you should do this and that for your governance and for your benefit. It is on the onus is on the organization to survive and grow. The management of any company, regulated or not, is charged with enacting governance and internal controls. This is the sole responsibility of the management. Coming to the lessons learned. So, what are the lessons learned? Lack of regulation is not an excuse. So, someone might cite, oh, SEC does not require me to do this, so why should I do this? RBI does not require me to do this. SEBI does not ask me to do this. Why should I do this? It is for your own internal controls. It is for your benefit of your own company as a going concern that governance and SOPs need to be there. Risk management practices, it is for your own benefit. Avoid FOMO and beware of star power. So what is FOMO? Is fear of missing out. So people had a fear of missing out on the crypto hype, and so they invested in the crypto. So because of the hype, they said, yes, you have to enter quickly so that you can exit with a big corpus, you can exit with a big profit. Hence, they sacrificed on the basics, they sacrificed on the due diligence, which should have done. They relied on third parties for the due diligence. So basically, all those aspects of due diligence were practically missing for all those who invested. In such cases, red flag is always independent due diligence should be done rather than relying on a third party, because after all, the money is yours. Also here, there was a charisma and star power, but there was no substance in that. So charisma can be there, but yes, you have to rely on your internal due diligence at the time of investing. Centralize the responsibility. So there were more than 130 affiliated companies, but no centralized responsibility for risk management. It is important that there is a centralized responsibility, someone who can summarize the risks of the entire organization, someone who can summarize as to, despite all these interconnected transactions, what is the ultimate picture that would be available. There was no context for the bigger picture. Interconnected of risk, connectedness of the risk was practically absent. Important points to learn is we should strengthen the relationship between management and the board, because the management is answerable to the board. There has to be a culture of accountability, oversight, and transparency. The board has to question the management on the action, and the management has to be transparent in its operations. So only transparency can strengthen the relationship between management and board. Second is assess the risks and develop processes for early warning signs. There were no business processes. Practically, the policies were just a makeup. Top risks that could go under or kill its reputations. That needs to be identified. What are the top risks and how they are mitigated? For the onlookers, the takeaway is, for us, it's a cultural story to learn from these mistakes. It's important that these discussions are being held in every organization, by every internal auditor, as to what were these things, what do we learn from this, and what is the importance of the policies, what is the importance of the processes, and how can we not repeat the mistakes. Coming to case study 2. The agenda for case study 2 is the recent judgments of the OCC and developments in internal audit, important excerpts from the judgment, and the critical aspects like gaming, self-identified issues. It's a very important aspect in internal audit, saying that, oh yes, it's a self-identified, but still it is a risk. Escalations, suspected fraud in the audit rating. So this is a judgment of 2022 December, okay, by Office of the Comptroller of the Currency, OCC. Now, what do we learn from this? The judge recommended stiff penalties against 3 former Wells Fargo executives, the CRO, Chief Risk Officer, and the CAE, and Internal Audit Director, over sales misconduct at the bank. The former CAE is being slapped with a $7 million fine. An audit director has been fined $1.5 million. Okay. Now, the fine against the chief audit executive is for failing to identify the root cause of team member sales practices misconduct in the community bank. Provide credible challenge when evaluating the effectiveness of community bank's risk management controls. Identify, address, and escalate risk management control failures that threaten the safety, soundness, and reputation of the bank. Office of the Comptroller of Currency. The Office of the Comptroller of Currency is an independent bureau of the US Department of Treasury. The OCC charters, regulate, and supervises all national banks, Federal Savings Association, and federal banks and agencies of foreign banks. OCC, or the Office of the Comptroller of Currency, ensures that the banks they supervise operate in a safe and sound manner, provide fair access to financial services, treat customers fairly, and comply with applicable laws and regulations. Now let's see in detail why did the OCC come so heavily on the internal audit function? Coming to where it all started. It started in 2013. So it took almost 9 years for the audit. 2013 and October 21st, 2013. Wells Fargo accuses workers of opening fake accounts to meet goals. Wells Fargo, pressure cooker sales culture comes at a cost. Right? So what happened? This was essentially a sales fraud wherein accounts were opened to get sales incentives. So what did they do? They put their own addresses on the accounts. So he wouldn't know about it. It showed up on the customer's credit report. That's how he found it. The customer found out and asked me, oh, I don't have this account. I don't have access to this account. But the address on the account was their own address. So he never came to know. They just tell the customers, you're getting a credit card. He admitted to opening unneeded accounts, though never without the customer's knowledge. He would call the customer, you're getting a credit card. When the customers complained, I don't want a credit card, then the branch manager would blame, oh, it's a computer glitch because of which the card has been issued. You can go and cancel the card. Okay. But without the customer's consent, his information, his data was used to issue a card to him, and the blame was put on a computer glitch. I had a 6-figure line of credit with Wells Fargo for several years, Levi said. There was no reason for me to open another account. He didn't need another account. But who needed was the sales guys needed incentives. They opened another account. David Douglas made similar accusations against Wells Fargo in a suit in September 11 in LA County Superior Court. He alleged the 3 Wells Fargo employees in Century City and Beverly Hills used his birth date and social security number to open accounts in his name and those of fictitious businesses. So here again, account was open without the requirement. Credit cards were given without the requirement. Signatures were forced. Addresses were used. Names were used. Personal information was used. In one case, the manager would greet the staff each morning with a daily quota for products such as credit cards, direct deposits. If you failed in meeting your quota, it meant staying after hours in office, begging friends to open the account and sign up the services. You'd say, I don't care how you do it, else you're not going home. It was a pressure on the employees, and look what the employees did. He said branch and district managers told him to falsify the phone numbers of angry customers so they couldn't be reached for the bank satisfaction surveys. So angry customers, anyway, they wouldn't participate in the satisfaction survey. They wouldn't pick up the phones, and their numbers were used to falsify. Employees would open premium checking accounts for Latino immigrants, enabling them to send money across the border at no charge. So those accounts could be opened with just $50, but customers were supposed to have at least $25,000 on deposit within 3 months or pay a $30 monthly charge. So opening the accounts was not an issue. To get around, they kept earning credit towards their quotas. Employees would downgrade the original accounts and open new premium accounts once for the customers before the fees kicked in. Customers surprised by all the unrequested credit lines, all the unrequested credit cards. said she went to complain at the branch where the account was opened. And a manager told her that the person who was responsible was one of the best employees. Why? Because he was always meeting his target. The bank closed the credit line, but they never gave him the apology. Now, if one of the best employees is doing this, then guess what? What happens to the rest? So now there were a plethora of incentives, plethora of integrity issues over here. The first thing was customer consent. So allegations of booking or sale of any banking product without the knowledge or official direct consent and joint account or product holder. That was the first thing. The second thing was false entries and violations. Allegations of entering false identification, expiration dates, or other false information in order to open accounts with or without consent. Third thing was fictitious customer. The customer is not at all there. You create a customer. It includes any product application where a falsified identification or SSN or social security number is used to mark the identity of the account holder. And the fourth category of integrity issue was online banking. Pinning online banking with or without customer consent and activating credit cards, accounts, line of credits is nothing but identification theft. The other issues were product manipulation, funding manipulation, reassignment of sales credit, and referrals. Waiving fees or adjusting products to open sales for unqualified customers. Steering customers, asking customers to buy products they're not qualified for or they don't want it. In either ways is just creating the numbers. Funding manipulation. Allegations of team members funding new or existing account. So basically account is created, it is funded, and of course the money is also withdrawn. So it's important, the chain and the manner of flow of funds here is important as to who is funding the account. Reassignment of sales credit. There was a team member who alleged that making referral contracts and he referred and reassigned the credits to another team member who was in need of the sales numbers. So they also kind of traded those numbers, sales numbers. Referrals. Invalid sales referrals gained by directing traffic or inappropriately received by another team member when an actual sales referral was not made. So basically there was no sales referral, it was shown that it is a referral. Now coming to the important excerpts from the judgment. The OCC judgment, it said that the community bank sales goals and management pressure led to thousands of employees to engage in these malpractices. Unlawful conduct. There was unlawful conduct and they tried to up their sales books through fraud, identity theft, funding, falsification of records, putting incorrect mobile numbers, putting incorrect addresses, and showing the numbers are up. Unethical practices to sell products of no or low value. The customer doesn't want the product, but you're selling to him. The customer is not eligible for the product, but you're selling to him. Why? Because you need the numbers. Collectively, many of these practices were referred to within Wells Fargo as gaming. What is gaming? Gaming is a term known at the bank. It was referred to employees' manipulation or misrepresentation of sales to meet the sales goal, receive incentives, compensation, or avoid negative consequences such as reprimands or termination. So going back to the fraud triangle, it is either incentive or pressure that has led to this particular state of affairs. Examples of gaming. So employees created false records and forged customer signatures on account opening documents. This is one of the case of global trends of last year. But I mean, I am not surprised that such cases have also been noticed in India in few of the recent verdicts by RBI. So here, after opening debit cards using customers' personal information without his consent, identity is stolen, falsely created a PIN to activate the debit card. So employees did that because, of course, they wanted a reward. And it required a debit card PIN to be activated. So personal identification was stolen. In some cases, employees created a simulated funding, which means false records by opening unauthorized checking and savings account. So there is a target that the account should be funded to an extent of so and so amount. It has been funded. But falsely it has been funded. Or to some other account. Then they transferred funds to the unauthorized account to meet the funding criteria required to receive credit or selling the new account. So in the stimulated funding, employees moved funds from existing accounts of the customers without their consent. Where do you create the funds from? Existing accounts of the customers, credit debit in the same day, and here you get one credit entry showing that yes, so much amount has been funded. Employees opened unauthorized applications for credit cards in customers' names using customers' authorization. Employees encourage customers to make test or token payments from the bill pay accounts. Lots of such incentives are there that if you bill, so this was only awarded for bill pay accounts that had made a payment. Employees at times altered the customer's phone numbers, email address, or physical address. Mind you, this was a very important thing. Can I have 5 accounts or 10 accounts with the same phone number and address? Okay. So these are some data analytic practices which should be done at the back end as to for how many accounts the same number is common. And that needs to be verified whether it is legitimate. Same numbers, same phone numbers, or same email address, okay, or same physical address, okay, it is a red flag. Okay. Why are, say, 100 accounts having the same phone number? So all these red flags were not identified during the audit. In some instances, employees did so to prevent the customers from finding out about unauthorized accounts. So what the employees did is they used anyone's mobile number or to be updated in those 100 accounts or 1,000 accounts. Customer would never ever come to know that his account in his name is being used for such practices, for upping the sales. Yeah. One more important factor was when it comes to customer surveys, the surveys or the phone numbers which were used for the surveys always were at the behest of the employees who gave good, nice, great surveys. So how did they do it? Millions of customer accounts falsely reflected a Wells Fargo email address as the customer's own email address, or it contained a generic and incorrect phone number so that the customer can never be contacted, or were linked to a Wells Fargo branch or Wells Fargo employee's home number. So it was anything but the correct number, either a wrong number or someone else's number. Millions of accounts reflected transfer of funds between two accounts that were equal in amount. Basically, X is transferred back to the account. Minimum amount for opening the latter account, and that thereafter had no further activity on the latter account. Many of the accounts were subjected to simulated funding. Many other instances, employees use their own funds to simulate actual funding of accounts they had opened without the customer's consent. That is also a crime, and even using other customers' funds to fund these fake accounts. Well, what was their contention? What was the contention of the internal auditors? So the internal auditors' contention was that these reporting requirements applied only to the extent that he was aware of something that in his professional judgment rose to the level of being significant. So Mr. Julian had expressed the view that he did not bear responsibility as chief auditor to escalate an issue if the business unit itself was escalating the issue, and neither did the rest of WFAS, Wells Fargo. So under this view, Julian disavowed any duty to escalate known issues down to either the A&C committee or the management committee. So this is nothing but Mr. Julian said this is something which the audit committee or the management already knows. So why should I raise it to the audit committee? If there is any evidence that the issue was being escalated by anyone. So acting in furtherance of these views, it was a breach of fiduciary duty, because whether the issue is self-identified or not, it has to be reported. Examination of suspected fraud. So the internal auditors had a responsibility to ensure that corrective actions were taken to strengthen reported control weaknesses or uncontrolled risks. They were also required to assist in the investigation of significant suspected fraudulent activities within the organization. Sales practices misconduct by community bank team members included fraudulent activity and indicated both weaknesses in risk management and presence of uncontrolled risk related to such misconduct. Notwithstanding these repeated red flags raised by the corporate investigations, and despite the understanding of the widespread nature of misconduct and failure of the bank, the first line of defense had identified the root cause of the misconduct and had in place effective controls. And the CAE had reported that the risk management controls and culture was satisfactory. So here is where the problem lies. It was reported as satisfactory. It was identified. It was said it was self-identified, not reported to CAE, and classified as satisfactory. There were instances in the audit report where the allegation or case did not warrant reporting to corporate investigations, even though there was evidence of banker non-compliance with proper sales procedures. So in this instances, the sales quality team issued emails instructing them to perform or provide training to the applicable team members. So they said that, yes, where the allegation did not warrant reporting, even though there was evidence, they said that, yes, we are doing training. We will conduct training. Metrics on the cases resulting in training email notifications did not differentiate between first time and second time training notification. So basically, training was just a word used to close the observation, is what I can say over here. Okay, there were no metrics as to how many trainings are conducted, how many of these cases those the sales employees were found to be using the same tactics. Were there any corrections? Have the number reduced? There were no metrics. The audit director was convinced that there was a systemic issue with sales practice misconduct sometime in 2015, but he never escalated to the bank's board. Audit's responsibility to identify the root cause of risk management issues. WFS was not required to identify the root cause of the sales practices issues, because tasking WFAS with identifying the root cause would not be consistent with their responsibilities. So here, the root cause was not identified. Internal audit believed that if a business unit identified, or if it was identified, it was the responsibility of the business unit, not the audit, to identify the root cause. Fraud was a deliberate misrepresentation that may cause any person or entity to suffer damages. So, is this not a fraud? This is the basic question. This is a fraud. And mind you, here the internal audit has failed in reporting such things. Misrepresentation was any false or misleading misrepresentation. Now, internal fraud is any event in which any suspected or known fraud operator is a team member or managed resources hired who committed fraud during the course of his or her employment or contributed to fraud. Now, all of the gaming activities can be attributed to fraud. So what happened in the fraud risk committee? So true name fraud was a fraud that occurred when an individual materially misrepresented his or her identity by identifying information that was the identity of another person. Okay. But this is nothing but a fraud. Team member gaming, including such misrepresentations. This was a name fraud. This was an identity fraud. This was a funding fraud. Coming to a quote from Mr. Henry Ford, the only real mistake is the one from which we learn nothing. So the question is, from these global trends, what do we learn? My third case study is a case study of a leaky app. Apps are ever booming. In India has one of the best systems of UPI, and money can be transferred. There is a lot of competition. But this particular case is a leaky case of a mess created out of an app in one of the leading banks. What is the mess? The mess is that, just like the previous case, the global case of Wells Fargo, in this case, what has happened is there were certain incentives given for the number of downloads of a particular app. And people have gamed the system by using the same techniques. So 1 year down the line, what we see, what was happening globally is also happening here. It all started with an innocuous reward. A reward was announced that any branch in which the app downloads exceed 30 will get a cake of 500 rupees per day. People were excited and they took it as a challenge. However, the integrity of the people was compromised and they did not take the challenge in the right spirit. Why? Again, coming back, it's the fraud triangle: pressure, opportunity, rationalization. Poor app security and third-party workers and employees game the system just for incentives. There were ambitious targets which were set up. And that was not the first thing. The cake was not it was only a topping on the icing. There were other incentives that drove this fiasco. There were fraudulent manipulation of technical loopholes in the app. So there were lots of technical loopholes in the app, which, as a matter of fact, in case of any app which has been started, launched, or wants to meet its target, it is a basic thing that app audit has to be conducted before the launch. The internal audit team has to check whether all the controls are there. Is there a device binding? It has to test it it has to be tested in the UAT, in the user acceptance testing, as to what is the outcome, How many people can register? You have to actually go and verify it, entering the data yourself, entering some fictitious data, and then checking whether the output is as desired. The basic purpose was inflating number of registrations on the app by multiple linking of the same mobile number. Again, here, if you see, the modus operandi is similar to the one case of Wells Fargo. Well, the questions to be raised. What are the questions that can be raised over here? Was the app audited for the technical controls? Was the systems audit done for the app? Was the device binding in place? What is device binding? So device binding means that let's say you enter a particular number, okay, from a particular SIM. And is it possible that you download the app on another mobile number and you just change the SIM and change that SIM frequently into 10 different mobiles and say, okay, I have 10 downloads, but in reality, it's just one mobile number. So that device binding is a very essential feature, and the device binding should be in place, and it shouldn't allow for change of devices of more than a particular frequency. That control is important. Third is, what was the mobile number? Was it unique? The answer is, of course, no. Multiple same numbers were used. Numbers were used of even sanitation workers just to get a number out of it. And obviously, they didn't have the smartphones. They used feature phones. Their SIM was used to download the app. And yes, go. Like they added one more of their sales apps download as the number of downloads for their app. Question is, how were their accounts authenticated? Was there a compulsory OTP both on the mobile and on the email? Well, answer is again, no, it wasn't. So these are some glaring examples of how we can learn from the global trends and implement the best practices in India to avoid such kind of frauds, and how internal audit can help prevent such frauds so that these cases do not happen. Of course, there is a very, very important issue of independence involved in it. I'm sure all my fellow chartered accountants will rise up to the occasion and ensure that they act independently, irrespective of the hierarchy, irrespective of the organizational structure. Now let us take a look at the important regulations. SEBI Committee on Disclosures and Accounting Standards, who advises SEBI on matters relating to disclosure, had put forward in one of its proposals that in case of listed companies, the function of internal audit must be mandatorily carried out by external audit firm, which ensures independence. Okay. Now, this is a little bit in contrast to what RBI requires. RBI requires banks and NBFCs to have internal audit function should be handled by someone within the organization rather than by external audit firms. Again, this is also, it can be looked at from both the ways. The committee, however, opined that with respect to a large size of certain listed entities and also for business insights it is more convenient to have internal auditors in-house, which is to be reviewed by the audit committee. The committee recommended that it would not be prudent to mandate that the internal audit function may be carried out by an external audit firm. And again, the views were solicited on this. Let us take a look at the regulations from the Companies Act. The Companies Act has a whistleblower mechanism. Okay. Again, important thing is it is also included in the statutory auditor's report as to what are the whistleblower complaints, how were they raised, how was the due diligence done, how were they resolved. Okay. It is mandatory with respect to Carver 2020 for the external auditors to share and comment on the whistleblower complaints. It is mandatory for the companies to share all the information on the whistleblower complaints that are registered with internal audit committee during the course of the year. And the last thing is the RBI regulations on risk-based internal audit, which calls for auditors' independence and compulsorily, mandatorily risk-based internal audit to be conducted. And internal auditor should have a specific structure of reporting directly to the audit committee to ensure independence. So what is the call to action? Well, lots of learnings from these 3 case studies. I'm sure all of you would have taken your key points and the key learnings which you would be implementing soon in your internal audit practice and your work. The safeguards and protections should be put in place for those who do fulfill those obligations. Time to expand the whistleblower statutes to protect internal auditors. Whistleblower statutes protect the whistleblower. In a similar manner, there should be statutes to protect the internal auditors, which as of now are lacking. Management and boards not enable or even permit that kind of scrutiny. They do not want and will not tolerate the internal audit function that the OCC seems to expect. So this is one major challenge. And as of now, it continues to stay that they don't want or they don't permit that kind of scrutiny. It is for us to subtly act and ensure integrity in our operations and in our audit assignments. With this, I conclude my session and over to the audience for their questions. Ayaz? Okay. Yeah, I request the participants. In case anyone has any questions. Ayaz, I don't think we have any questions. So with this, thank you all for your participation and enthusiastic response. With this, I end the session. Thank you all for joining on a Wednesday evening. Thank you so much. Okay. Okay, we have received a question. Are AI and IA, intelligent automation, capable to safeguard and protect the frauds, leaky apps, etc., as mentioned in your case studies? We've received this question from Sudeep Ghoshji. Thank you, Sudeep Ghoshji, for your question. To tell you very, very frankly, like just giving an example, yesterday I taken an Ola cab and I had to go to the city for some reason. And, the paths showed a particular way. And I could see the way directly that we had to go straight. But the path showed a roundabout. And the Ola driver refused to listen to me and go straight. He said, no, it is showing left. I have to go left. Okay. And I said, okay, you take your route. And the route was, I don't know, it was totally wrong. And he took the left and there was a roundabout and we came back to the same place and wasted 5 minutes. Now, this is what technology has. Sometimes people refuse to see the obvious and they say, no, I have to go by this rule set up by the technology. Okay. So, in my view, the human mind supersedes all technology. Okay. No amount of AI, no amount of automation can be sufficient to safeguard and protect us from frauds. They are just tools, and you should know how to use those tools. Ultimately, it is the human mind who has to make the decisions, no matter how many AI or no matter how many IA, intelligent automations, are used. Yeah. We have another question. How to identify fraud in purchases where bills are within limit of passers? Okay. So there is a technique called Benford's law, in which, based on the last digit of the numbers, or based on random generation, random sampling, random generation of the numbers, you can identify if there is a fraud in the billing amount. Okay, because if a particular digit is getting repeated continuously, it is quite possible that it has been made up. Yeah. The next question is, in the case of FTX, do you consider to a certain extent authorities let the organization reach to such a point? Yeah, well, to the extent that they reached this point and they had so much of funds invested in them, and the authorities kind of were silent at the time that it reached such a big fallout. Yeah, I would say that yes, the authorities were blind to the extent of that. Also, I would put some onus on the external auditor as well, because he was certifying the statements, and the disclosures which were required were, I would say, absent. Even the kind of policies that were held, that was these red flags were there, and it should have been taken off. I mean, it is very easy to say, however very difficult to implement and come out with a solution and come out with the reporting of such cases. But this is what the profession demands. Yeah, Vinod Kumarji has said, how do you handle the issues of fraud being committed by highly placed sources? Fraud committed by highly placed sources. This is a very nuanced one. So with respect to internal audit, I can say one thing, that internal audit has a direct reporting with the board. It has an audience with the audit committee. So one must use these meetings, one must use such sessions to bring out the lacuna and to point out the lacuna. Yeah, there is another question. What is the solution when management does not agree with IA observations? Also, IA fees are held back by the management for the same. So if you see over here in my presentation, I had raised those issues whenever an external auditor is there for the internal audit function, or for that reason, even an internal person is an employee and he is there on the internal audit function. So there are two ways: either you convince or you be convinced. That is one. And if not, then you have to give it a hearing to the audit committee. And at the end of the day, you need to do your job better. I mean, the fees are there, yes, but you can only come out by reporting such issues. I hope I have answered all your questions to your satisfaction. Thank you, everyone, for your enthusiastic participation. Thank you, Ayaz ji, for your technical support. Thank you so much.